Good morning, everyone. Please put yourself on mute. And if you have any questions, put them in the chat. And after the presentation, we will go to your questions. Thank you for being on time. Welcome to our Good Morning Rockville education series. And today we're thrilled to have Chaya Kundra join us. And Chaya is a tax litigator and advisor. She's the founder of Kundra Associates. Hold on, I'm trying to let people in and read at the same time. I'm sorry. She represents clients in all stages of tax controversies and international tax disclosures to the U.S. She assists businesses, nonprofit organizations, and individuals in cases involving civil and criminal tax litigation, employment tax matters, and a lot of other things. I'm not going to read it because it's so long. But she's been practicing in the U.S. and international tax for over 28 years and brings with her the passion, conviction, and knowledge needed to resolve the most complex of tax matters. Thank you so much, Chaya, for doing this for us and educating us. And I'm going to turn it right over to you. Everybody, please mute yourself and put any questions you have in the chat. Thank you.
Thanks so much, Margie. And thank you everybody for being here. It's my pleasure to talk about one of my favorite topics, perhaps not yours, which is employment taxes. Because we are a small group, I am good with answering questions in between, especially if it's super relevant to the specific item we're talking about. Employment taxes are one of those kind of sleeper taxes. And I say that because a lot of people, if you happen to be a mega company, it's not going to be something that's affecting you. But if you make less than $20 million a year, this is going to be something that might be affecting you. When I say less than 20 million, I'm talking about 20 million in gross receipts. So employment taxes, when I talk about this, I'm going to talk about it from the perspective of what they are, how they're going to potentially impact you as a business owner, what the IRS is looking at and looking for. And then I'm also going to talk to you about how to protect yourself, resolution options. We're going to have some sexy criminal tax cases. And we're also going to talk about essentially what the IRS is going to do to collect this tax. I am assuming that everyone has a little bit of an idea of what employment taxes are about and what they are, but just as a slight primer, what are they? So employment taxes are different than independent contractor taxes. Independent contractors are just individuals that are kind of essentially like consultants. Whereas employment taxes are, you're my employee. I'm directing you. I'm telling you where to go. I'm telling you when to show up. I'm providing you with training. You have absolutely not absolutely, but you basically don't have to worry. If the client didn't pay us, I still have an obligation to pay you. So there's a financial control. There's a behavioral control. And these are the people that are showing up every day. So what are employment taxes? Employment taxes are the taxes you're paying on the wages you pay for your employee. Okay, so what does that mean? So I'm going to use a very simple, I'm going to use a simple example that we're going to use throughout the presentation, and that has to do with $100,000. You have an employee, and that employee is going to get paid $100,000. As you know, as an employer, you're going to take off 7.5%. That is the employee's portion of FICA and Medicare. And you as the employer are also going to contribute 7.5%. The employee is probably going to say, you know what? I want you to also do some voluntary withholding for me. So that's going to say, and we're going to say in this case, it's going to be $10,000. So the employee, while on paper looks like they're getting $100,000, they're actually getting $100,000 minus $17,500, right? Because we've taken the $7,500 and we've taken the $10,000 out of voluntary contributions. So the employee is actually taking home $82,500. But remember that $17,500 you withheld? When you are withholding that money, you are in a fiduciary capacity, which means that you are standing there and you're holding that money in trust for the Internal Revenue Service. It is your obligation as the responsible party, which we'll talk about a little bit more, to pay that money over. So for those of you who are paying employment taxes, you know within 3 to 5 days, you're sending that money over, okay? The collection of employment taxes, when that money is collected from you as the employee, as the employer and not taken over is huge. Okay, so remember, we withheld the money from the employee at the 17,500. You as the employer also have to contribute the 7,500. Okay, so when you're thinking about whether or not I want to hire an employee or hire an independent contractor, when we're thinking about the level of control, the amount of money that we're going to be paying this person, the next time you hire, I don't want you to just think I'm paying them $100,000. I'd like you to think about the fact that I've also got to pay them employment taxes, right? I have to pay their employment taxes. So I would suggest that next time you're going to pay that person $100,000, why don't you tack on another 10%? Because that's what it's going to cost you to actually have this employee. When you think about the amount of taxes you're going to have to pay in, when you think about the amount of filings you're going to have to do. And on top of that, remember those benefits? Think about those benefits, because one of the things that we do as employers is when we run short on cash, sometimes we think, remember that withholding I took out of that employee's paycheck? Oh, no one's really going to pay attention. I'm just going to take it because I really need some money on R&D, or I've really got to pay that supplier because they're on my back. And I'm going to ask you, if you don't want to end up being my client or the client of another tax person, don't do it. It's going to end up in a situation where we have 3 days, okay, 3 to 5 days, depending on your payroll, to submit that money. And if you don't do it, the IRS has now gotten so good, within 45 days, they're going to send you a notice. Okay, so the next item I have here is amount withheld. Employment taxes. So the Internal Revenue Service collects about 98% of the GP, the gross revenue of the United States government. 98% is collected by the IRS. And of that 98%, 70% represents employment taxes. So they're on it. It's important. And with about, I'd say 8 years ago, the IRS decided and Department of Justice decided that, we've had this law on the books for a while, but we don't really go after people criminally. We need to scare people into making sure that they're going to pay these taxes, and we need to set examples. Don't become an example. We'll talk about how that is, and it's so easy to step into that exampleness of employment taxes, and now the IRS is going to say, you didn't just kind of mess up and not pay these taxes. You went ahead a step further, and you purposely decided to pay somebody else over and above the Internal Revenue Service. And we'll talk about what that looks like and examples of what the IRS considers to be paying somebody else over and above the Internal Revenue Service. Overview. So the types of employment taxes that you're going to be looking at is your 940, which is the annual return. And that has to do with unemployment. You're probably familiar with it because it does marry well with the unemployment taxes that you pay to the state of Maryland. And the unemployment taxes that you pay to the state of Maryland, you get a credit for on your Form 940. The Form 941 is your quarterly employment tax return. That's the one that everybody files that has employees. 943, agriculture, 944. So I've got 3 more here. I'm going to focus more on the 940 and the 941 because that's the most prevalent and common type of tax. And that's the one that you're going to be like, yeah, I've heard of that one. Okay. The most common types of non-compliance. I have this out first because I just want to talk about a little bit like how it's kind of really easy to not pay your employment taxes. And this one is kind of one that makes me smile all the time because the government likes to call it pyramiding, but pyramiding is just accrual. So let's say that I've got a quarter, I had to pay these taxes, but for some reason, I really had to pay the R&D. I have this great idea. My software is almost there. I've got an R&D. I'm just going to take $30,000 out. I'm going to pay it back. It's not a big deal. My other client's going to pay me. It's just $30,000. Okay. And then it happens the next month because nobody said anything. And then it happens the next pay period. And now all of a sudden we're starting to accrue these balances. The IRS likes to call it pyramiding. What I think of pyramiding, which is what they had in the old days, is when I'm going to go ahead and set up this company and I've accrued all these balances and, oh gosh, maybe it's like $300,000 or $400,000. Maybe the IRS knows about it. You know what I'm going to do? I'm just going to shut my company down. I'm going to go ahead and open up a whole new entity, a whole new EIN number. And then I'm just going to have the same employees maybe, maybe have the same, probably going to have the same consultants and the same contractors and the same vendors. Pretty much everything's the same or slightly different. Now I've got something called a pyramid. To me, that's pyramiding taxes. That's what the old name used to be. But as far as the IRS is concerned, pyramiding is just the accrual of employment taxes. Okay, so it's going higher, it's going higher, it's going higher. Now let's say that you've gone ahead and you created a new entity, or maybe you put your spouse's name on the new entity, or maybe you've gone ahead and used your child's name on the entity. Okay. There was a period of time when the IRS would look for successor liability, successor companies. There's a time when they would look for alter ego companies. They'd say, you know what? We know what you did, and we're going to go ahead and take the liability from that old entity, and we're going to apply it to the current entity. And we're going to add on the liability that you owe for this entity. Okay, but the IRS, like 10 years ago, just stopped all of this. And now, because there's a recurrence, the last commissioner of the Internal Revenue Service was a gentleman who used to be a practitioner. And the thing about, or the danger of having a practitioner be a commissioner of the IRS is that they kind of know what their clients do. They kind of know where the taxes are hidden. Like, you wouldn't want me to be the commissioner. And they know how to go after them. So he said, you know what, we're going to bring all this back. We're going to bring back the alter ego. We're going to bring back the brother sister company. We're going to bring back transfer liability. So if your thought process is, I'm going to go ahead and set up another company or another corporation, you're not going to be safe in the woods, because the IRS is going to wise up to it. And it's important that you think about that. And it's important that instead of creating one, even if your accountant tells you it's a good idea, or your tax preparer says, let's just do it. Or even if your tax preparer says, hey, let's just change the way your employees are and turn them into independent contractors. Think about it, because what I hopefully will get across to all of you is, if you do encounter a tax obligation, you can resolve it. There are so many ways that we can resolve tax obligations, and they don't have to be as painful as they sound. But the longer we wait, the higher the balances get. Sometimes, well, the more painful it'll become. Unreliable third-party payers. This was one that makes a lot of sense. I happen to be a business owner. I don't want to deal with the nitty-gritty of having to pay employment taxes. I don't want to deal with the nitty-gritty of, like, oh, did you get your benefits? Did you get your insurance? I'm just going to go ahead and I'm going to go ahead and hire somebody that's a third party. Not a bad idea. The thing is, and I can tell you, I have a third party that does my employment tax returns, and I have a third party that pays my employment taxes. Okay. So it's because I don't want to be bothered with it. And the calculation's a pain in the backside, right? Some of you have QuickBooks, which is also a great tool. But remember, your tool is only as good as you're paying attention to it. Okay. So what was happening in the past is that you would have these companies, and I know it was a huge one in Maryland, where the payroll company, I think it was like FastPay or something, the payroll provider essentially took over to the point where all your notices were now being directed to the payroll provider. So you weren't even being told whether or not the taxes were being paid. You just figured it was happening. These PEOs, professional employer organizations, or these payroll service providers will close. You don't know what's happened, and now you're footing a bill. So what's really important, because you don't want to be bogged down with everything, is one, make sure that no matter who you ever hire, whether it's a lawyer, a payroll service provider, an accountant, it doesn't matter. Make sure you're always getting your IRS notices. I know they're ugly. I know you don't want to see them, but they're really, really important, because it's going to let you know if you're in compliance. The second is, do not let them change the address. You've got to make sure you're paying attention. Third, you probably have the best bookkeeper in the world. That's fantastic. But please make sure you're looking at your bank accounts. And when you look at them, look at the time your payroll is being made, and make sure there's a withdrawal. Okay, two types of withdrawals. One, the automatic withdrawal is coming out for your employees to get paid. And two, that the employment taxes are being sent over. Okay, super important. And they take 5 seconds, just a quick glance from you, because you know when you're making your payroll. The next one I want to talk to you about, or the other one, is offshore employee leasing. This was kind of a big deal a while ago. It's not as sexy, but sometimes habits die hard. And this is when an offshore company is going to come to you and say, we've got this brilliant idea. If we take your employees and we send them offshore, you no longer have this obligation to pay employment taxes. It's not true. And they'll call it deferred comp, but it's not deferred comp. And it has been considered an abusive transaction by the IRS. And the thing I want you to keep in mind about it is that both the promoters and the participants were held liable. Okay. So even if you're going to count on somebody else, you're still going to have a measure of liability. So as an owner, it's really, really important that you don't turn a blind eye. I'm going to tell you all a funny story. When I first started practicing law, I was, a young lawyer, and I used to get these letters from the IRS, and they would freak me out. I'd be like, oh, and then I'd have to take a breath and be like, oh, wait a minute, it's for my client. So imagine if I'm feeling like that, and it's not about me, it's about you all. It's scary, right? But there's this Japanese proverb that says, always most beautiful right before. You can use that for always most fearful than right before. Please do not ignore your mail. Open those letters. The faster you can get in front of it, the more control you have, right? And I think it's football, right? The best defense is a better offense, or maybe I said that wrong. But the point is that you want to be on the offensive. You want to get in front of the liability before the liability gets in front of you. Because the minute it starts to snowball, you have to change track. And you're going to find yourself in a situation, often when you have an employment tax situation, it's because you have a financial issue. And you want to make sure that you're in a position to be able to get in front of it, get a reasonable resolution with the IRS. Hiding, running is going to make the IRS less likely to want to help you out. And remember how we talked about that fiduciary responsibility? The IRS seriously considers employment taxes not being paid in the trust fund portion. They consider that as stealing. And they don't look favorably upon that. And we're going to get to that a little bit more about that trust fund portion, but the hint is that amount that you withheld for your employee, that portion is the trust fund portion, the fiduciary portion, okay? Misclassifying worker status. I used to see this a lot from even accountants who've had clients for a really, really long time, and even business owners when you decide these employment taxes are kicking me in the butt. I don't want to do it anymore. You know what, Mary, you're really nice. I don't want to get rid of you. Here's what we're going to do. I'm going to now pay you as a 1099. You just withhold your own employment taxes. It's not a problem. And everybody stays and we're all going to be fine. But you're not going to be fine. You can't have somebody who was an employee that was operating as an employee, then being in the exact same position, doing the exact same work as an independent contractor. The IRS is going to come back and say, no, sorry. That's not an employee. And then what's going to happen is that you're now going to have to pay back taxes for it. A lot of times when you get caught in these types of situations is when the employee gets upset. Maybe they're disgruntled because they didn't get along with another employee in your office, or they didn't get along with you. They're going to go ahead and file an unemployment claim. And then you're going to say, oh, that person was an independent contractor. I don't have an unemployment issue. And then they're going to say, no. I was an employee just 6 months earlier. So you want to be consistent with how you're treating your workers. If you do have somebody who's going to become an independent contractor, make sure they do all the right things. Get yourself a contract. Make sure that they get a new EIN. Make sure they start operating like a business. If they're not willing to take those steps, you really want to reconsider whether or not you're willing to hire them on as an independent contractor. Not securing a proper TIN. A TIN is a taxpayer identification number. Those of you who have businesses are going to be getting something as an EIN, an employer identification number. Our social security numbers are SSNs. TINs are numbers that are just taxpayer identification numbers. They're often given to people who are here temporarily, who are maybe migrant workers, here for a short period of time. Sometimes we will have, and this is not an employee situation, but sometimes we'll have those independent contractors that might be a friend, might be somebody you know, might be somebody who's on the cheap. And they're going to give you this TIN. You're going to pay them more than $600 to do some work. And then the social security number or the identification number is wrong. When that happens, you need to know that you may have paid $300,000 in contract workers. When you get audited, if you cannot show that those workers had valid TINs, the likelihood is that the IRS is going to take that $300,000 and attribute it back to you as income as the owner. I just want to throw that in there because I know it's not exactly the same as the employment tax, but it is a tax that you're going to end up paying as the owner. Okay. And even if you're a Schedule C corporation, it's just going to be considered a constructive dividend to you. Okay, misclassifying worker status. If you misclassify on purpose, you're not going to get something known as Section 530 relief. And the classification of workers is another program that we could talk about for hours. I'm not going to spend too much more time on it here, but it is, if you're not sure, the IRS used to have like this set of examples, which were like 11, and now they've broken it down to 3. I recommend you go to the IRS website and take a look if you're not sure. And of course, talk to your accountant, talk to your lawyer, talk to your payroll provider. If I don't know how much they tend to know about this stuff, but it is important that you're clear on who is a worker versus an independent contractor. Paying employees in cash. This is a hot one. People like to do it. There's nothing wrong with paying your employees in cash. The only thing is that it becomes difficult because you're not necessarily tracking how much you've paid them. You want to make sure that the 941 and the 940 are tracking the compensation you pay people in cash. Another hot button item with this is crypto, right? I want to pay my employee in crypto. Why not? It's the hottest thing. And the thing about crypto is it's not considered currency as far as the IRS is concerned. And in my own biased view, it's never going to be considered currency because the IRS is not going to have something compete with the US dollar. Okay, but that's the sidebar. So the thing about crypto that becomes kind of fun and interesting from at least a legal perspective is if I'm going to pay you, let's say in Bitcoin, and the Bitcoin today, and I know it's not, but let's say Bitcoin today is 1 for 1. One Bitcoin is worth $1 today. And you pay your employee in Bitcoin, and you may have an employment contract that says, I'm going to pay you $200,000 a year. $100,000 is going to be paid, and you're going to pay them all in crypto. Okay. So at the time you're paying them, it's 1-to-1. But by the time the year ends, all of a sudden the money you've paid them has now gone, it went from 1-to-1 to now it's 50 cents to 1, right? It's half. I have a contract that said I was going to get paid $200,000. The value of what you paid me was $100,000. The IRS doesn't care. The IRS is going to expect you to pay the crypto and that value. You may have down the road an employment issue because the person's going to say you were supposed to pay me $200,000 worth. The value ended up being $100,000. It's out there. It's a possibility. I'm not a fan of paying people in crypto, but it's going to happen. If you're going to do it, it's completely okay. Just remember that you have to account for it. And whether or not the taxpayer, your employee comes back to you later and says, you didn't pay me in accordance with our contract, you did pay them in accordance with crypto. There's risks to crypto. And as long as you paid the Internal Revenue Service the value of the crypto. So let's say, for example, it was $30,000 in crypto, and the value of the crypto at the time was $30,000, you have to pay the United States government in US dollars, the value of that crypto, okay? So similar to paying employees in cash, you just got to properly account for it. The crypto just means that you have a few more mathematical calculations. Okay, filing false or no payroll tax returns. No matter what, do not file a false payroll tax return. Second, file a return. It is better to file than not to file at all. If you don't file, the IRS thinks you're hiding something. If you file something false, then you have another whole set of problems. I had, and I was going to talk about this later on, but I'm going to just talk to you about it right now. I had 2 clients that came to see me within like a month of each other, and it was really interesting. They both owed about $2 million in tax. One filed their returns, was getting hammered by the Internal Revenue Service. You got to pay, we're leaning you, we're going to do this. The other one hadn't filed returns. Who do you think got the ding dong doorbell from criminal investigation? It was the person who hadn't filed the returns, because the one who did file the returns, IRS was on the door, they were knocking, and we were trying to work it out. The person who didn't file the returns, the IRS was like, hey, what are you hiding? What's going on over here? And it was lovely in that we were able to get that one resolved without a criminal sanction, simply because we were able to prove that the client tried very hard to resolve their tax liability. So we have letters to the IRS. Hi, please help me. They were misguided. They didn't go to the right places, but at least we were able to produce them, and the IRS showed proof of receiving them. So that helps with that client. Okay, so please file returns. Number 8, I'm jumping to, which is treating compensation as a corporate distribution. It's going to go with reasonable comp, and I'm going to combine those two when I talk about them. Number 7 is PPP loans. I'm sure that most of you took advantage of the PPP program. If you had employees, I would hope that you took advantage of the PPP program if you qualified. I know this is going to come as a surprise, but there were some people who decided to make fake entities or make claims for PPP for employees that did not exist. The fun thing about this is that CI, criminal investigation, does not need to knock on your door because proving it is so easy. So you're going to have maybe the postal inspector knock on the door because you mailed in that return, or you're maybe going to have just your local state attorney person knocking on the door saying, or the people they send out knocking on the door saying, hey, you guys have a problem because you perpetrated loan fraud. PPP loans are huge. The amount of money that people got from it, the amount of just false entities that cropped up was amazing. And here's how easy it is. I'm going to claim that I had 5 employees. I'm going to get $500,000 and bam, there's no 941s. There's no 940. There's no evidence of me ever paying an employee. And how hard is it to prove that? Not very. So the PPP loan is an objective of the SBA. It is working with the IRS to try to collect on it. If you are worried about a PPP loan that may not have been as accurate, I do strongly suggest you again get in front of it, as opposed to having the SBA or somebody else knock on your door and say, we think that you might have done something inappropriate. Okay. Treating compensation as a corporate distribution. A lot of us, when we have what's known as a disregarded entity, that would be an LLC, or if you're a single owner of an entity, what'll happen is that you'll get the tax advice of saying, listen, you're a service corporation, you're a service organization, you're not making anything. So the best thing for you to do is treat yourself like a partnership. The beauty is you go ahead and say, I want to be a partnership, but I don't want to have all that liability. So why don't I look into electing to be treated as an S corp? Brilliant. You file a tax return. There's only one tax. You're not taxed at the S corp level. Instead, you're going to get taxed at the individual level. Okay. The thing that you need to remember is if you are 100% owner of an S corp, if you are 100% owner, if you are working in the company, you are going to be considered a statutory employee. So if you happen to have independent contractors and the only person really working in the company is you as a statutory employee, you want to remember that you will be considered an employee. So even if you only gave yourself distributions, the IRS is going to come back and it's going to attribute to you income tax, employment taxes. So that's where number 6 comes in. You want to basically structure it so that you're giving yourself employment tax. You're giving yourself payment as an employee. When I say that, it's also kind of easy because if you think about it, when you are getting only money as a partner, it's really hard sometimes to figure out your estimated tax payments. And it can become cumbersome. And then again, if you get behind the 8 ball, the next thing you know, April 15th is there. And I don't care if you do an extension, your taxes are due by April 15th. The next thing you know, you're going to get hit with the liability. And on top of it, oh, maybe you had reasonable cause. Maybe something happened. It's going to be very difficult to walk away from the estimated tax penalty. So let's get back to reasonable compensation. This is going to be something that not only as the owner of an S corporation, you're a statutory employee, but you've got to pay yourself reasonably. So let's say that you own a software company, and that software company, you're the person getting the business, you're the person who's managing it. You want to think about how much would somebody else reasonably pay if you work for them. If they would reasonably pay $250,000 a year, then make your salary about that much. Don't pay yourself as much as your secretary or pay yourself as much as your most junior assistant. Don't do that, because the IRS is going to come back and say, sorry, it's not reasonable comp. We're going to attribute it to you, and then you're going to have an employment tax obligation, and it's going to accrue. Lawyers end up getting in this trouble a lot. Depending upon the body that regulates you, there are certain instances where, for example, if you're an attorney and you happen to have employment tax problems, you're going to have issues with renewing your license because there's this whole obligation to be honest and upright and all of that good stuff. Okay, So let's talk about recent collection updates just for a second. 3 years, the IRS has become a lot more timely in assessing the trust fund penalty. We're going to talk about how that happens. 99% of the assessments are happening within 45 days. Okay, wait a minute. How do we get that to happen? So you remember how you file your employment tax returns, your income tax returns? You sign those wonderful things under penalties of perjury. You are saying, hey, I owe this money. That's it. Government does not have to go and get a lawsuit. They don't have to get a judgment. They don't do anything. You've done it. 2 things you want to keep in mind are the statutes of limitations. There's a statute of limitations on assessment and a statute of limitations on collection. This is going to affect income taxes as well as employment. The IRS has 3 years from the day you file an income tax return to come back and say, we agree or disagree. If they say nothing, then the statute on collection starts from the day you file. If they come back and audit you or change what you owed, then it's the date of the last valid assessment. It's 10 years to collect, okay? Employment tax returns are a little wonky and they add to that statute about between 3 to 9 months. Okay, so when you file that return, it doesn't take the IRS very long. They know that you didn't file it. They know you didn't pay it. 45 days. Are they going to start right away with a seizure? No, it's those notices. Remember that mail I told you to open? That's where it's coming from. The first one's going to say, hi, sorry, I have to move over here a little bit. Oh, this way more. Hi, just so you know, you didn't pay that tax return. Hi, just ding, pressing it over. Next one. Hey, letting you know. Next one. Okay, you know what? We're starting to get a little angry because you're not paying any attention to us. Then there's going to be CP notices, and it's going to start as a CP 501, a CP 502, CP 503. CP 503, you have to start being worried about. CP 504, you're going to start to look at getting levied. But there is a fail-safe. Remember, you got to open that mail. There is something called a collection due process hearing. And before the IRS will take forced collection action. Now, remember, I said they don't have to go to court, but they can levy you like that. They can take that money out of your bank account. They can go ahead and contact your vendors. And they can say, hi, IBM, I understand that you're going to pay Joe Smith. But before you pay Joe Smith, he owes us some money. So what is that going to do? They're going to get the money. And now IBM knows that you have a tax problem. That's going to mess up with your relationship with IBM. So while the IRS may sometimes not think that far ahead, you need to be thinking that far ahead. You need to come up with a resolution. And before they do it, they will give you notice. So what you want to do when you get that CDP, it's called a collection due process hearing. You want to get on time, okay? Because you get this option once, only once. And it's 30 days. You have 30 days to timely request a CDP. And basically what happens is it kind of stops the IRS from taking forced collection action. Also, what it does is it gives you an opportunity to come up with a resolution that you can afford. And maybe the resolution is that I can't afford it and I need to look at an offer and compromise. And that's also okay. But the most important thing you do when you come up with a resolution alternative to the IRS is you must, and I can't stress this enough, you have to be in current compliance. You can't say to the IRS, hey, can we work this out? And by the way, I'm continuing not to pay the taxes. Because it's kind of like any of us. If you have somebody who owes you money and they say, listen, can I make a deal on that last 50 grand I owe you? And I'm not paying you now. You're going to be like, no, we can't make a deal. You got to be in good faith. And the IRS's major requirement is that you are in current compliance. That's not even like a maybe. It's just, that's what it is. You have to be in current compliance. Okay. So when the IRS looks to individual obligations, because I'm going to be, if I'm the IRS, I get 2 bites. I get to come after you as an individual and I get to come after your company. And that's what we're talking about today, right? Protecting the owner. So CDP, I just want to make sure I wrap up the CDP. Make sure you do it within 30 days, unless you've got a statute that's expiring. And then you want to look at it in not doing it within 30 days, but within a year. The 30 days gives you the right to go to tax court. It's kind of nice when you're dealing with IRS appeals to have another level of review above them, because I think it keeps everybody kind of in checks and balances when they know something else could happen. The second thing that you want to keep in mind is that the CDP will stop the statute of limitations. And that's important because if you want that statute to keep running, you may not want to preserve it. Now, if you've got like 6 years, it's okay because the CDP will be resolved within 9 months. Okay. There will be a CDP if there's going to be a lien, but the lien will be filed first and the CDP writes second. Sometimes you'll get lucky and the revenue officer will say, I'm going to file a lien, and you have the right to an appeal, and you can talk to the government about why they shouldn't file a lien on your business, how it's going to impact your ability to earn money. The code section you're going to be looking at is 6323J. And the reason that you're going to have to prove to them that it's actually going to have a negative impact on your business. And while it sounds easy, it's not that easy to prove it, because these days having liens it's not that uncommon. Okay, so I have on here that every trust fund recovery penalty is considered a criminal case. They look at it from a potential criminal case. We're going to talk a little bit about that in one more second. And just remember, even if CI decides that they're not going to go after you criminally, it doesn't matter. It doesn't mean that they can't seize your assets. It doesn't mean they can't look to successors. It doesn't mean they can't look at issuing injunctions. We're going to hit that at the very end. Injunctions and potential short incarcerations. Okay, how's the IRS going to make sure it's getting money from you? Audits, we all know about those. Tax liens, we just talked about them. Levy, talked about that. TFRP is going to be next, injunction, and fraud referral. Okay, what has happened in the last 3 years is that the Internal Revenue Service created a new fraud referral system. A fraud task force. What used to happen is if you were getting audited or if you were getting reviewed, whether it was under a civil audit or whether it was under the like a revenue officer was looking at you for TFRP penalties, what used to happen is if they thought something was funny, they would go to a fraud examiner and they'd say, can you take a look at this? And there's a certain amount of criteria that has to be worked out. And the IRS would decide whether or not to pursue a fraud action. Now, I'm going to tell you the fraud penalty, the civil fraud penalty is 75% of what you owe. So it can be pretty steep and pretty sick. Now, there's these fraud task force. There's 4 across the nation, and it's not manned by that many people, but it's so much more focused. And it's basically helping the guys, those with the boots on the ground to know quicker and faster if there's a fraud issue here. If there's a fraud issue here, remember, not only are you looking at a civil fraud penalty, but you're also potentially looking at a criminal penalty. So the TFRP, I keep forgetting which slide I can do this on. Okay, 3 main code sections that I want you to look at. The TFR, and I have these code sections. I don't know how many of you are attorneys, but I always find that if I'm going to have my back up against something or something may apply to me, I kind of like to know what the rule is. So I just have this up just so you all know what the rule is. 6672 is where the IRS can assess the person who is responsible, the responsible party for the liability. 7202 is the criminal provision that talks about willful failure to withhold. 7201 is the criminal provision that talks about the willful failure to file. Okay. And then they considered an evasion. You didn't file the income tax on purpose. Okay. So 6672, this is where I get to be held responsible, or I as the IRS will hold you responsible for failing to pay over the tax. Now you remember, I said there's that fiduciary hat that you put on. You're standing in that position. The IRS is going to say there's 2 prongs to this: responsibility, knowledge. Okay. Did I know about it? And could I do something about it? The first thing off the bat is, did I have access to that bank account? Because that's going to put me in the willfulness category right away. I'm the owner of a business. Come on, I'm busy. I'm figuring the employment taxes are getting paid. My controller is handling it. The person who does my payroll is handling it. I don't have time. And every time she's tried to talk to me about it, I've just told her, look, just deal with it. What have I just done? I've turned a blind eye. Is that going to exculpate me from liability? Nope. It's not, because I had knowledge. The fact that I didn't want to see it doesn't make it go away. Remember those notices, open them up. It's the same thing. I know sometimes life gets crazy, we get busy, but it's kind of like when you're a parent, you don't get to stop being one. And it's the same thing when you have a job, you have to still focus and be there. And please do not ignore the IRS. Okay, 2 prongs, responsibility and willfulness. So your bookkeeper may know that you're not paying the taxes, but your bookkeeper can't do anything about it. Your bookkeeper's not the one who has access to electronically submit the payments. Your bookkeeper, just is telling you about it, but can't do anything about it. You're the one who's directing. Your bookkeeper's okay. Now you've given your bookkeeper access. Your bookkeeper is in a position to be able to access the bank account. Guess what? She's now responsible. Your bookkeeper knows about it. Your bookkeeper keeps telling you about it, and you keep yelling at him. And he still has access. What's the IRS say? He could have quit. He should have just quit, but he didn't. He's going to be held responsible. There's a case actually that I cite that talks exactly about that. You'll be surprised how many people can be held responsible. And as far as the IRS is concerned, the more the merrier, because this tax is a joint and several tax. So what does that mean? It means that while I can collect against the employer, I get to now collect against you individually. I will go after your house. Oh, and just so you're clear, now I'm going to go after your partner too. And I don't care if the amount of tax owed is 300,000 and 200 of it is the trust fund portion. Remember that portion that you withheld on behalf of all your employees? Well, that portion, I'm going to collect against all of you. And I don't care if the company pays 100 and you pay the other 100, it's all good for me. If you have a responsibility for trust fund and non-trust fund, and you get to pick trust fund first. Because remember, the IRS considers that money you stole because you took it out of one pocket, put it in yours instead of giving it to the other person, right? This is the money that was withheld from your employees. Responsibility, function, duty, status. That's it. The fact that the controller is talking to somebody else at the water cooler saying that they're concerned about the employment taxes, it doesn't matter. That person is not, they may have knowledge, but they don't have responsibility. Okay, so TFRP can be imposed for the willful failure to collect, the willful failure to pay, the willful failure to file, any of these. And it's going to be equal to the amount of the tax that was not paid over. Okay, not the amount of collected, just the amount of tax that was not paid over. So if you decide not to withhold, you're still responsible. And where it says here, it's not going to be the employer's portion of the FICA, even though the employer is still responsible for it. Okay, so how does the TFRP actually get assessed? The TFRP gets assessed like this. The IRS is now noticing that you're not paying employment taxes. You're going to get a knock on the door, and there's going to be this revenue officer, and he's going to be super nice. And if it's fun, he might wear a trench coat and look like an FBI guy. And, you know, and you're just like, whoa, what's up with that? Actually, I had that experience one time. He came to my office and I was like, man, you so look the part. It's so cool. He ended up becoming a group manager and probably one of the best IRS persons I've ever worked with. And to this day, I use him as a resource because he's just a really cares about his job, which is what you want. That's the other thing. Don't be afraid of these people. When you're working with the government, you know, they're just trying to do their job. Now, sometimes if you're not represented, they kind of become overly aggressive, and that doesn't mean you can't handle it. You just got to stay on your toes, and you've got to know what they need to know. And so a great resource for that is the Internal Revenue Manual. And there's a guide of how the revenue officers are supposed to work and operate. Okay, so their job is to determine whether or not you are personally responsible or who the other people are. They're going to do this thing called a 4180 interview. And in that 4180 interview, they're going to ask you a series of questions that they actually have a form for. And it's the 4180. And it's going to be about an hour long. They're going to ask who had signatory authority. They're going to ask who also had the ability to direct payroll, who was deciding who's going to get paid. Because a lot of times you're going to decide that your rent needs to get paid, your utilities need to get paid, you're going to decide your vendor needs to get paid before the IRS, and the answer is no. If you decide that your ex-spouse needs to get paid so you can get them off your back, the answer is no. If you decide that you need a Maybach in your driveway to make you feel good about going to work and inspire you, instead of paying your employment taxes? The answer is also no. Don't buy the Lexus, pay the employment taxes. I know it sounds tongue in cheek, but you'll be surprised, because remember how I said that now there's this whole fraud task force and they're getting the folks with the boots on the ground even better at fraud? One of the things the IRS revenue officer is going to do is they're going to ask for your bank records, the company's bank records, and they're going to want to know what you were paying. They're going to look at your income tax returns. They're going to look, and I say your, I mean the employers. They're going to see where the money's going and they're going to follow it. And they're going to see how much you as the owner are making, and they're going to see where you're paying things. So if your kids' college tuitions suddenly get paid, or you happen to start taking nice vacations, you've gone to Fiji, maybe you've gone to Thailand, whatever, things that you normally couldn't afford on your salary, and you're starting to do it, they're going to take notice, because they're going to say, you know what we think's happening? We think you're taking that money and we think you're going ahead and lining your own pockets. And boom, now you're now in the area of fraud. Okay, so if the IRS comes after you, your comptroller, your office manager, and four other people, there's four of you the IRS comes after, you are going to want to consider whether or not to hire separate counsel for all of your other employees. If you've decided that they're going to be represented by you, or the company's still going to pay it, that's another thing to think about. But remember, it's a collective, it's a joint and several liability. And also, if you don't believe that the assessment is right, you have 60 days. Before the assessment is made, you can contact the IRS revenue officer's group manager and say, whoa, something's wrong, this is not okay. Alternatively, or in addition, you have 60 days to protest an assessment. I'm going to bring this back to another situation. Now, let's say you had a company that's defunct and there's no way the government's going to collect, and there's CDP action. I would take the CDP action just so you can confirm that the government is going to close out the company as defunct. You are the owner of the company and you have no fiscal ability to pay. If you have no fiscal ability to pay these taxes, the IRS can decide not to pursue you, because it's a waste of their time if they can't collect against you. Okay. And remember, once the IRS only has 3 years to make the TFRP assessment, and from that 3-year time, they have 10 years to collect, unless they go ahead and take you to court and reduce this down to judgment, which they can do. Okay. You get this TFRP assessment. You can file for bankruptcy. It will not be discharged unless you do a 13, but I don't recommend bankruptcy. First of all, I don't do bankruptcy, but I also don't recommend it because it ruins your credit. You can do an offer in compromise when you have a trust fund, when you have trust fund as well as employment taxes. When you do an offer in compromise, that's when you say to the IRS, listen, I owe you all this money, but if you look at my financials, there's no way I can pay you within the remaining years of the statute of limitations. It's just not going to happen. It can't happen. We need to make a deal. You can't just, and for those of you who are used to it, you can't just pick up the phone and say, listen, client owes you 300,000. How about you take 2 and we call it. It's not going to work that way. They need to know financially, they're going to do their due diligence. And by the way, those 433Bs, 433As that are signed under penalties of perjury, if you lie, the IRS will come after you for criminal activity. Okay. I don't ever, as a practitioner, I don't ever personally sign them. I always have my clients sign them because they know their numbers better than I do. Okay. Installment agreement, also something the IRS is willing to work out. There's fast pay installment agreements where there's less obligations to provide financial information. But if you have the opportunity, what I strongly recommend every single time is pay off that trust fund liability as fast as you can, because the rest of it, they're not as interested. They want to collect it, but they're not going to breathe down your throat for it. Okay. Criminal or civil. We've been talking about this. I've been alluding to it. What's happening? Okay, here's somebody who's never going to be able to get away with it. It's going to be me. Tax professionals, forget about it. You've done it. You're going down. Okay. Multiple acts of wrongdoing. Inconsistent documentation. Okay. We're going to see some of these in some of the cases that we're going to go through. I want you to just look at this long thing, this thing at the end, evil motive. Nobody needs an evil motive. The IRS, when it looks at something, the thing is that when the IRS comes to you, it's already been 3 years. or 2 years. You've already filed that return. The data is historic. It's not so much if you did it, it's what you did the minute you found out your obligation. Did you take the right steps to try to do the right thing? And I will implore you, the minute you find out, try to do the right thing, because that's going to give us, as your representatives, an easier time negotiating a resolution that's going to work for you. Okay? If you want to continue to perpetrate the act, it's fine. It's kind of like that movie from Liar, Liar, which I don't know any of you guys saw it, but as a lawyer, I recommend that lawyers see it. It's really funny because the secretary says to the lawyer, so-and-so just knocked over an ATM. Do you have any advice? And he can't tell a lie, and he picks up the phone. He goes, stop breaking the law, which is, kind of funny. But you guys are breaking the law if we're not filing those returns. If we are paying in cash and not reporting it, it's breaking the law, and it's just a matter of time when the IRS is going to find out about it. Okay, I want to just switch over to willfulness. Willfulness is two different things. There's civil willfulness, where I know that my person was supposed to pay it over and they didn't. There's criminal willfulness, where not only did I know they were supposed to pay it over, I know they didn't do it, but I intentionally took the money and put it somewhere else. I intentionally took the money and I paid creditors instead. I intentionally took the money and paid the loan shark instead. I intentionally, whatever reason, I knew what I was doing. I knew I had an obligation. And if I happen to be sexy enough, the Department of Justice is going to go ahead and decide to make me one of, the poster child of why you have to pay your taxes on time. Speaking of poster children, financial distress, sympathetic circumstances. I've got the case names, IDs down here, but boy, John, he decided to pay his creditors instead of his employment taxes, found to have acted willfully. Next case, while this person was not involved in day-to-day management, they held meetings periodically. They did have control over the business. They would meet with the company's manager. They had authority over the finances, and they were the only person authorized to sign the checks. Bam, found liable. Remember the one I talked to you about with the comptroller who was verbally abused? Found liable. This is the case, Burnaby. Wells, this is a fun one. The husband said he was taking over the tax matters, lies about it, intercepts all the IRS correspondence. Wife doesn't know about it. She's the owner of the business. Bam, she's still a responsible officer. If you find yourself in a situation where you have a partner and you are part of a company and taxes are not being paid and you want to get out and make sure you put it in documented writing. I am no longer part of this company. That's what the wife should have done. So the liabilities that were there until you were there may be assessed to you, but once you quit the company, you've now made an affirmative showing and record that you're no longer going to be responsible for anything that happens with the company. The next few cases, we've got like 2 minutes left. Do you all have questions for me? I'm sorry, not 2 minutes, 8 minutes. Do you all have questions for me, or should I just keep going? Margie, I'm going to leave it on to you. Keep going. Okay. This is just fun to get tax lawyers kind of when they are supposed to be doing it. This guy was an experienced attorney. He moves employees and assets around. Okay. Here's the thing. When you look at the sentencing guidelines, what happens is that when you've committed a criminal act, and it's a federal criminal act, like taxes are, the IRS there's certain things like sentencing guidelines. What the IRS does, not the IRS, but what the courts will do is they're going to ask a very big question. Was what you did sophisticated? And if it's sophisticated, we're going to knock that sentence up. So sophisticated things are going to be like, I have multiple entities. I'm paying you in cash. I'm setting a different corporation up, and I'm going to have you get paid from that corporation, even though you work for A corporation, but I'm going to have you paid through B corporation. How sophisticated am I going to be? And how many actions am I going to do just to avoid having to be clean about my books? This person has a medical clinic. He's willfully fails to pay over the trust fund. He doesn't pay over the employment taxes, and he's paying his employees in cash. We've already talked about this, not reporting it, and then he's pyramiding. There's another one that's really fun, which is where this one is the one I wanted to point out. This person has a staffing agency, and it's a nursing staffing agency. And I see a lot of this happening a lot with these healthcare staffing companies. This company had an obligation to file to say that their nurses were all employees. And yet, what does he do? he goes and treats them like 1099 workers. The documents found, and bam, now he's sentenced to 48 months of imprisonment. Because there's that inconsistent documentation. He knew what he was doing. He was very clear, and he chose to do it anyway. Crab fails, decides to leave off some of their employees from the 941s. Okay, not the best idea. Because remember, I'm going to file my taxes. And this is the other thing I want you guys to think about sometimes, you folks to think about, which is kind of interesting. If you put yourself on payroll and you aren't paying employment taxes, we're going to talk about that in a second. But if you have an employee, I'm coming to work every day, and I'm thinking that you're paying my employment taxes, right? I'm the one that's making that $100,000. I'm going to, and by the way, I have 7 children. I personally don't. It would be fun if I did. But if I have 7 children, that $10,000 I paid in, I'm going to get a fat refund. So the government is going to do what? They're going to process my income tax return, and they're going to give me that refund. But here's the kick. That money was never paid in, right? So now we have this big loss, but now let's change the situation. I'm now the employer. And not only do I have personal knowledge that that money didn't get paid in, I filed my tax return and I got myself a refund. Now have I perpetrated fraud yet again and lied? Absolutely. So, ooh, there's another way for the government to get me. Okay, so you want to go ahead and make sure, you want to be consistent. The ones I have is these current examples. This person, this is a Maryland company, manufacturer, owned, he was responsible for the operations. He withheld it, didn't pay over $2 million. He's got to pay 3.4 in restitution, looking at 5 years. Next person, this is a construction company. And this one is a great example of sophisticated means. He sets up one corporation directing others to has a cash check cashing business. He's paying people off the books. He's not reporting it. It just goes on and on. He's looking at like close to 30 years because of the level and the amount of activity that he undertook to not pay his taxes. Another thing I want to talk to you about really quickly is your mobile forces. You're going to have people that are going to be working remotely. Make sure you are cognizant of paying their employment taxes. And the thing that's going to possibly get you with this is state taxes. If you have an employee that has decided that they're going to live full-time in New York, but are working for you in Maryland, you may have a New York state employment tax obligation. Think about it. Remote is huge. These states are coming after you. And just like the feds, while the states don't have as much power because they just don't have as much resources, the feds, you want to watch. Most of the time when there is a federal tax liability, there is a state tax liability. And now you've got crypto and you've got cash payments, and oh, let's go ahead and add that I'm not living in Maryland. So you've got a lot more things happening. It's getting more complicated. Make sure you're clear on the rule of the state that your employee is deciding to live in. This one is a software developer. Just the government's really not, they don't really care who you are. They're just going to come after you. This gentleman operated also a cash payroll, files false income tax returns, and doesn't pay the taxes, looking at imprisonment and supervised release afterwards. Okay, the last thing I'm going to hit on, and I have 2 minutes left. Oh, I had 3 questions. Just really quickly, if the IRS doesn't feel like it's not going to come after you criminally, it doesn't feel like it's getting anywhere from you from the TFRP, they're going to file a civil action against you. And basically, they're going to have injunctions, they're going to have requirements of you, they're going to extend the ability and the time they can collect against you. And what they'll do is they'll make it a court order. So Marjorie, I think there's 3. So do you want me to go after those or? Oh, no problem. So civil actions are also something the IRS is going to be looking at. And it is another toolbox. They're going to file an injunction. For those of you who don't know what an injunction is, it's when the court comes back and says, sorry, you don't get to do this anymore. And it's kind of funny because really what they're saying is you don't get to not pay your employment taxes. You don't get to set up a new company without us knowing about it. You don't get to, sometimes you get this overlord who's going to be watching everything you're doing. And that happens to be a revenue officer. Before the IRS does this, they're going to send you a letter, 906. again, open your mail, call your representative, get this taken care of, because you do not want this. You don't want a court order. You don't want a court action. All you got to do is just work it out with the federal government, and you can. They want to work it out. They want to get paid. You want to stay in business, and everybody just wants to play nice and kind of hit the reset button. Okay, I think I am out of time, Margie.
I want to thank you so much. Does anyone have any questions? You can unmute yourself and ask Chaya. There was just a couple in the chat from SHS Payroll, who actually does our payroll too, and I can highly recommend them. And Lynn Perry Parker said, excellent presentation. Anybody have any questions? No? Okay. So I want to thank you so much. This was very valuable, very, very valuable. And I know people with the PPP loans were doing things that weren't supposed to be happening either. I think there was a line there, but anyway, no. So I want to thank you very much.
I have a question. I apologize.
Okay.
I thought the meeting started at 10 when I just found out about it yesterday. I see it was recorded. Is it possible for me to get a copy? Because I would like to have a conversation with Miss how you pronounce the name? Chaya
Kundra.
Chaya,
You can call me
yes.
Chaya or Miss Kundra, either one, whatever you're comfortable with.
Okay, could I put my email in the chat and you can send me the presentation so I can
This recording is going to be on the Chamber's website on the bottom under our blog, so you can watch it there. And,
okay.
and her email and phone number is right at the bottom of this slide here. So if you want to take a picture of that, you
maybe I don't see it on this slide that's on my screen.
okay.
It's C. Kundra at kundrataxlaw.com.
Okay. Yeah, I did. I've put a request out yesterday on your website, and someone did reply back, so I'll catch up with that. But I don't see the contact.
It's my phone number is 301-424-7585.
7585.
Yeah, and my email is just my first initial last name. So CKUNDRA at, and then KUNDRA taxlaw.com.
Okay, great. Thank you. Thank you. I find it. Thank you.
Okay, thank you, everybody. Chaya, thank you so much. Appreciate it. And
It was super fun. I appreciate it, Margie. Thanks for having me.
great. Everybody have a great day, and hopefully we'll see you December 15th at our holiday party at the Hilton.
Thank you.
Okay, thank you. Bye-bye.
Bye-bye.
Ms. Kundra, can I call you?
Of course.
Can I call after this presentation? A quick question.